Silver is like a candle burning at both ends. Silver closed lower, but the low on the day was $65. It recovered back to 73, rounding up. Silver historically has had really volatile moves, whether it's up or down. Gold has declined on my short-term fib retracement below the 61, but above the 78% correction level. We're witnessing a reversal, but my mind tells me that fundamentally nothing has really changed, so why would you get that major pivot? We pivoted to bearish because fundamentally that doesn't make sense, but technically gold prices got frothy. My call of $6,000 is standing because I expected a correction, and it's early in the year, so by year end to go to 6,000 would require that market sentiment of bullishness that's been prevalent for quite some time, geopolitical military action has elevated, which should maintain at least the price of gold, if not take it higher, and we're not seeing that.
Take a look at a chart of silver. Silver is also down below $80 an ounce now. And I wonder if silver is just following gold or acting on its own. Maybe we'll pull up a chart and we can analyze that together.
So we're looking at a daily chart of silver futures. Right now, it still bases the most active March contract, but it will switch to the next most active, which is 3 months out from the March. And you can see, let me compress this a little bit. I've got my fib data set from about $48 per ounce. That occurred in November of last year, up to the all-time record high. And I know I didn't predict silver would move up that fast. I acknowledge that silver is like a candle burning at both ends. It is twice as bright, but it typically lasts half of the time, and the differential between that and only having it lit on one end is significant. But the drop that we witnessed was tremendous. If we go from here to here, we've surpassed the 61% retracement. This low here came to the 78, and this low here came really short of going, but it requires, you look at the length of this tail, this is what we saw today. Silver closed lower, but the low on the day was $65. It recovered back to 73, rounding up.
Silver didn't just correct. It unwound faster than most models could handle. As Gary Wagner points out here, the move from $48 to all-time highs and back through a 61% retracement shows how unstable momentum-driven rallies can be. A drop to $65 intraday with a sharp recovery to $73 signals aggressive dip buying, but also panic exits happening simultaneously. This kind of long-tail volatility often appears when leveraged positions unwind, not when fundamentals change. For investors, that means price action is being driven more by positioning than conviction right now. Next, Gary Wagner shows whether silver is actually leading or just reacting to gold.
And we're seeing the kind of volatility I would expect in silver versus gold. One, gold has a much greater liquidity due to the number of contracts that are in our open interest for the most active month. Silver does not. It's a much more concentrated trading vehicle. If someone's looking for a precious metal that's considered a safe haven, it is gold, with silver playing a far back second, and that would explain the kind of volatility that we're seeing. And silver historically has had really volatile moves, whether it's up or down. The difference of current data is that we've never seen silver above $100. I mean, the high was right around 50 for the last decade or so, and that's significant. We saw silver run to above $120 per troy ounce, and that was an extremely overheated market, more frothy than gold when it went to an all-time record high if you look at the differential. And that, to me, explains why we're seeing the kind of volatility we are in silver with the huge moves both up and down. A critical point, gold has declined on my short-term fib retracement that I have up here, below the 61 but above the 78% correction level. 78% to a market technician, although this is a short Fibonacci data set that I'm using for the retracement, is still within the realm of a simple but deep correction.
The silver is just volatile narrative hides a deeper structural weakness. As Gary Wagner points out here, silver's lower liquidity and concentrated positioning make it far more susceptible to sharp, exaggerated moves compared to gold. A surge past $120 followed by violent reversals isn't strength. It's instability fueled by speculative flows. When a market overshoots historical ceilings this aggressively, it often signals excess leverage rather than sustainable demand. Investors should question whether this is a true bull cycle or just a liquidity-driven spike that's now normalizing. Next, Gary Wagner discusses whether gold's correction is still healthy or something more serious,
rather than a pivot from bullish to bearish. On the other side, you can see that gold broke through the simple 50-day moving average, which is a major line in the sand for most market technicians. Below a 78% correction starts to reveal that the probability that we are witnessing a pivot from bullish to bearish is in play. And the interesting thing is this is occurring with great strife in terms of the military conflict between Iran, multiple countries, and Israel and the U.S., which did attack them. And while I'm not offering you a definitive answer whether it's a pivot to bullish to bearish or a correction, we need a little bit more data, but we're right on the line of where that could happen. And it does look like the potential that we're witnessing a pivot is real when we look at the charts. But considering the fundamentals at play, nothing has really changed. The anticipation was that the Fed would maintain rates where they were, but yet when that announcement came out, it dropped tremendously. We've had, on a candlestick chart, four consecutive lower lows and lower highs. In the middle, you see a double doji there. And that usually means that there's indecision in the market. We could expect a bounce up, but what we saw today was a continuation of selling pressure.
Markets are flashing technical warning signs at the exact moment fundamentals say they shouldn't. As Gary Wagner points out here, breaking below the 50-day moving average while nearing a 78% retracement puts gold right at a potential trend shift. Yet, geopolitical tensions and steady Fed policy should be supportive, not bearish, which creates a serious disconnect. 4 consecutive lower highs and lows with a doji pattern signal indecision, but the continued selling suggests institutions are leaning defensive. For long-term investors, this is where discipline matters more than prediction. Next, Gary Wagner unravels whether this divergence is temporary or the start of a deeper shift.
When, except for the announcement by the Fed, which was a high probability, I think it was about 98%, according to the CME's FedWatch tool, that they would maintain them. So we are getting closer to the point where I will say it is likely we're witnessing a reversal, but my mind tells me that fundamentally nothing has really changed, so why would you get that major pivot?
So I will point out that Gary has correctly not only called the direction to the top, but also the direction to the bottom. Late January, when you came on the show, you had said that you're expecting gold to retrace back towards $5,200, 51 to 5,250 to be exact. It's done exactly that. When gold broke through the floor below 5,100, Gary, for the first time, what was your reaction?
Well, my reaction was that obviously I was short. I might have gotten the direction right, but my levels didn't equal the actual market moves. So in that way, it's troublesome to me. But as an analyst, I understand you don't always get things right because things can change. The quagmire here, the one thing that I'm attempting to absorb and explain in a rational manner is which the fundamentals at play now.
A 98% certainty from markets didn't prevent a sharp sell-off, and that's the real signal. As Gary Wagner points out here, even when Fed expectations were fully priced in, gold still broke below $5,100, exposing how positioning can override fundamentals. Calling direction correctly but missing levels highlights a deeper issue. Markets are reacting to flows, not forecasts. When analysts get the what right but miss the how far, it often means volatility is being driven by institutional repositioning. For investors, this is where risk management matters more than conviction. Next, Gary Wagner shows why fundamentals still aren't aligning with price action.
With the military action, not only involving the US and Iran and Israel, but Iran attacking multiple Arabic countries that are around their border as kind of a revenge thing, because each country they've attacked, there's a US base there. And so I think it's a little too early to make a really positive claim that we pivoted to bearish, because fundamentally that doesn't make sense. But technically, gold prices got frothy. They became dramatically overbought as we saw that rise up. And we know that when that happens, the likelihood is of a steep correction or a pivot. And that's going to take a little bit more data to answer. Right now, we are within, in my mind, acceptable parameters where it still could be a simple correction. My call of $6,000 is standing because I expected a correction, and it's early in the year. So by year end, to go to 6,000 would require that market sentiment of bullishness that's been prevalent for quite some time still remains. And I don't see a reason that that's changed. Although the Fed didn't cut rates, it was expected that they would maintain their current Fed funds rate. As far as inflation goes, the Fed considers hardcore target at 2%. We have been well above that for quite some time. It's 3.4, depending if you're looking, the data set that you're looking at in terms of time parameters. And so that's going to be troublesome to the Fed, but it has been troublesome to the Fed. And how do you change that? Typically, you lower rates, and they didn't do that.
A $6,000 gold target survives even as the data underneath starts to crack. As Gary Wagner points out here, the market remains technically overheated despite geopolitical escalation, and inflation still running around 3.4%, well above the Fed's 2% target. That's the contradiction investors need to focus on. If inflation hasn't been solved and rates haven't been cut, why is price momentum fading? It suggests positioning got ahead of reality, not that fundamentals improved. For portfolios, this means managing expectations, not chasing narratives. Next, Gary Wagner discusses why gold isn't reacting the way it historically should.
The fact that gold should be responding to escalating tensions and an escalating war. I mean, it went the other way, right? And this is a question that I've been asking people. Yes, gold should be responding to lower rates. It hasn't happened yet. But if you notice something very interesting, Gary, after February 28th, which was the day that the US and Israel commenced their strikes on Iran, the DXY, the dollar index, rallied. And it looks like the world flocked to the dollar once more as a safe haven asset and not to gold. And of course,
Correct.
Gold sold off. Maybe just comment on that. And
certainly,
yeah,
that to me is an easier question than how low will it go. Gold and the dollar have both been considered safe havens for decades. And when we saw the run up, they were obviously investors by their positions that are reported were showing that they were still overall bullish. This recent move shows that there was a shift. That's what's been driving it down. And the interesting thing is happening when nothing has changed except the level of uncertainty and geopolitical military action has elevated, which should maintain at least the price of gold, if not take it higher, and we're not seeing that.
When war escalates and gold falls, something deeper is shifting beneath the surface. As Gary Wagner points out here, after February 28th, capital didn't move into gold. It rushed into the dollar, pushing the DXY higher instead. That's not just a rotation. It's a signal that global liquidity still trusts the dollar system more than hard assets in crisis moments. Historically, gold leads during instability, but this time positioning and currency strength are overriding that narrative. Investors should question whether safe haven still means what it used to. Next, Gary Wagner unravels where that displaced capital may actually be going.
The only response I can give is crude oil has been extremely volatile. It broke above 100 just a few days ago. It's now just below it at about 97. And so that indicates the potential for money managers and professional traders to shift from either the dollar or gold into crude oil. That would make sense to me, meaning that it doesn't mean that the sentiment in gold has changed so much. It's been rising against a tremendously strong dollar that's been rising in terms of percentage gains, much more than we typically see in that currency, our currency. And so the only explanation that I can offer that makes sense to me is that the professional hedge funds, the people that are holding the largest positions in futures have made a strategic shift from gold and the dollar to crude light.
Okay, so when you evaluate the question of how low something can go after it's broken down technically, just walk us through the thought process here. Walk us through your methodology.
Sure. If you look at this chart here, I've got a very short-term fib retracement that starts really at the beginning of the year.
The real story might not be gold falling, but capital quietly rotating elsewhere. As Gary Wagner points out here, crude oil breaking above $100 and holding near $97 suggests institutional money may be shifting toward energy instead of traditional safe havens. That's a critical signal because it reflects where hedge funds see immediate opportunity, not just protection. If gold rose even against a strong dollar before, then this drop hints at reallocation, not collapse. For investors, sector rotation matters more than headlines. Next, Gary Wagner shows how technical levels define just how far this move could extend.
And then goes up to the all-time record high, meaning this last major rally, it fell from grace hard. In 2 days, it gave up a huge percentage point, and that's this red candle and this red candle here. But it is still above the 78% retracement. That is an acceptable level for a correction rather than a pivot. What challenges that assumption is the simple 50-day moving average is the line that's in green. The other day we broke below that. And that's another kind of line in the sand for a market technician. If equity or an asset group or an asset class is trading above the simple 50-day moving average, we consider that to be still in a bullish demeanor with positive market sentiment. A break below that is the opposite. We believe that this is giving us technical, empirical, in other words, analysis that's a hard line in the sand using the 50-day, and we are definitely below that. We broke through that the other day. So as long as we remain above on my chart, that 78% retracement, and that comes in at 45.68, we can still make the case of the potential that there wasn't a pivot, but a steep correction.
A 2-day drop doesn't define a trend, but breaking key levels might. As Gary Wagner points out here, holding above the 78% retracement keeps the correction narrative alive. Yet slipping below the 50-day moving average introduces real doubt. That's where technicals start to outweigh sentiment, especially for institutional models that rely on these signals. A level like 4,568 now becomes critical, not just for charts, but for investor psychology and positioning decisions. For long-term holders, this is where discipline replaces emotion. Next, Gary Wagner discusses what happens if that final support level fails.
And the steep correction, that makes sense to me. Gold got overheated. It got frothy. It went up tremendously to an all-time record high above $5,600. I'm looking at April futures on my chart, and then just crashed through that level with a vengeance, almost $1,000 correction, which if you look at gold at $5,000 or above, that's about 20%. So the evidence isn't concrete, but it's looking more like a pivot, which does not make sense in my mind, because no matter what a chart shows, we all recognize, the market technicians that use this kind of data in a chart, that it is fundamentals that creates market sentiment, not necessarily a line in the sand like a 50-day moving average or a fib retracement. And so that's where I've got hardcore evidence that it could go one way or the other, but I'm not convinced that there was a major pivot, and that's what we're looking for. Corrections are to be expected, but we haven't had a pivot from the bullish demeanor, which has been going on for quite some time, and this could be a moment that we're getting it, but there's no confluence with the fundamental data, because hardcore, we're not yet at a point in terms of the retracement, but I can move that data set and make it longer or shorter. If I make it longer, we're right at the 38% retracement, a real acceptable correction. On the short-term fib, which I have up, we're approaching 78. We've broken through the 50-day moving average. That's a red flag. If we break through the 78% retracement, I will have to acknowledge that there is not overwhelming, but good technical evidence that a fundamental shift in market sentiment has taken place. We're not there yet, but we are right on that line in the sand.
A $1,000 drop in gold isn't just a correction. It's a stress test of the entire bullish narrative. As Gary Wagner points out here, a near 20% decline from above $5,600 pushes the market into a zone where technical signals start conflicting with macro fundamentals. The real issue isn't the pullback, it's the lack of alignment between charts and reality, especially with inflation and global risk still elevated. When price action diverges this sharply, it often signals institutional repositioning before a clearer trend emerges. For investors, this is where patience beats prediction.